How do you navigate the changing tides of commercial real estate investment, especially in the face of evolving work dynamics? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. The office sector is undeniably undergoing significant shifts, and according to Jim Brooks, president of BH Properties, these shifts present unique opportunities for innovation and strategy refinement. Urban Land recently interviewed Brooks, who shared insights into how his company is adapting to these changes. Brooks, with a rich background that includes roles at the Cole Company, Morgan Stanley, and Tishman Speyer, emphasized the importance of embracing the redefined office model rather than waiting for a return to pre-pandemic norms. In late May 2024, BH Properties made headlines with their acquisition of Pacific Place, a 335,000 square foot shopping center in downtown Seattle, which was only 45% occupied at the time. Their strategy? Attracting a mix of local, regional, and national retailers to create a first-class shopping experience that resonates with the unique culture of Seattle. Brooks articulated that BH Properties' approach involves acquiring well-amenitized buildings with a reset-in basis, providing a competitive advantage when leasing space. He highlighted that their focus is on value and utility rather than sentimentality about the traditional use of office spaces. If an office asset can be repurposed, they are ready to make that pivot. In the past year, BH Properties has acquired numerous office assets at significant discounts, sometimes 60 to 70% below replacement cost. These acquisitions include high-profile properties like Hazard Center in San Diego, 989 Market Street in San Francisco, and the recent addition of the Park on Barton Creek in Austin. Brooks detailed their strategy of assessing key characteristics such as location, infrastructure access, and zoning flexibility to determine the highest and best use of properties. This pragmatic approach allows them to repurpose assets as flex space, small bay industrial, or retail when appropriate. The company's product-agnostic approach enables them to adapt swiftly to market demands, with a recent focus on Class A office spaces acquired below replacement cost. Brooks noted that their strategy is driven by basis, not just market trends, allowing them to capitalize on opportunities across different property types. In repositioning these assets, BH Properties prioritizes creating environments aligned with current tenant expectations, such as incorporating outdoor spaces, flexible layouts, and amenities that support hybrid work models. Brooks mentioned that listening to feedback from the brokerage community and end users is key to aligning improvements with market needs. The multifamily sector in the United States is showing remarkable resilience and growth, according to the latest U.S. Multifamily Market Beat report by Cushman & Wakefield. In the first quarter of 2025, the demand for multifamily units remained robust, with nearly 102,000 units absorbed, a 12% increase over the same period in 2024. This demand is fueled by steady household formation and affordability challenges in the for-sale market, a trend that is expected to continue. Interestingly, for the first time since 2021, demand has outpaced supply, with 95,000 new units delivered in the first quarter, a decrease of 25% compared to the first quarter of 2024. This decline in new deliveries reflects a broader trend of reduced construction activity, with the pipeline now 34% lower than a year ago, returning to 2018 levels. The economic landscape continues to influence rent growth, which held steady at 2% year-over-year in the first quarter of 2025. While this is slightly below the historical average of 3 to 3.5%, it demonstrates resilience amid economic uncertainty. The South of the United States, particularly Dallas/Fort Worth and Phoenix, led the nation in absorption, with significant population growth driving demand. The shrinking construction pipeline, especially in Texas, has been a welcome development for investors, as new deliveries have declined significantly. In areas like Dallas/Fort Worth, Austin, and Houston, there are nearly 60,000 fewer units under construction compared to last year, indicating a pullback in supply that could support further recovery in fundamentals as long as demand remains positive. Rent growth continues to show mild improvement, with markets in the Northeast and Midwest outperforming others, showing rent growth of 3.2% and 3.9% year over year, respectively. Notably, Northeast Arkansas led the nation with a 5.9% rent growth. Meanwhile, markets like Austin and Denver are experiencing rent declines due to robust deliveries, but overall, the multifamily sector remains strong. In a strategic move to expand its industrial footprint, Basis Industrial, a privately held and vertically integrated real estate owner and operator headquartered in Delray Beach, Florida, has successfully closed on a significant acquisition in the Dallas-Fort Worth area. The transaction, which was finalized on May 1, 2025, involves the addition of 519,476 square feet to their portfolio, marking their first investment in the Richardson submarket. This acquisition includes the Arapahoe 1 through 9 and Westwood properties, a series of infill industrial assets located in Richardson, Texas. With this strategic purchase, Basis Industrial has increased its total presence in the Dallas-Fort Worth region to over 2 million square feet. According to Anthony Scavo, president and managing partner of Basis Industrial, this acquisition has been a long-term target due to Richardson's strong fundamentals, limited supply, and promising long-term upside. In addition to expanding their physical holdings, Basis Industrial is also establishing a new regional office at Arapahoe 7, which will serve as the central hub for their Texas operations under their property management arm, BaySpace. This move is part of their strategy to bring leasing in-house for these assets, enabling them to maximize operational efficiency and market responsiveness. Currently, Basis Industrial owns and manages more than 5 million square feet of industrial space and over 1.5 million square feet of self-storage space across the United States. They have a projected pipeline of an additional 2 million to 3 million square feet expected to close by the end of the year, further solidifying their position in the industrial sector. Whitestone REIT has announced the acquisition of the San Clemente at Davenport, a 31,832 square foot restaurant-anchored retail center in Austin, Texas. This acquisition aligns with Whitestone's strategy of enhancing their portfolio with neighborhood-focused, open-air shopping centers in key growth markets like Texas and Arizona. The San Clemente Center is strategically located near major technology hubs, including the Apple and Tesla campuses, which positions it well for long-term growth. The acquisition complements Whitestone's existing Davenport Village retail center at the same intersection along Loop 360, an area recognized as one of Austin's most traveled corridors. This marks the fifth neighborhood shopping center in Whitestone's portfolio, located in Austin, Texas's capital city. Whitestone plans to leverage its strong market position and institutional knowledge to enhance the performance of the asset and unlock its significant upside potential. San Clemente is situated in Austin's affluent submarket with an average home value within a 1-mile radius nearing $1.5 million and household incomes exceeding $280,000. The area is marked by strict development restrictions and proximity to protected lands, which have limited new retail developments over the past 7 years. Despite this, the surrounding area has less than 40% of Austin's average square retail feet per person, indicating a high demand for retail space. The center's location at the intersection of Loop 360 and Westlake Drive benefits from over 55,000 vehicles per day in supporting traffic and is expected to gain from the completion of the Loop 360 project. Austin's strong in-migration and booming tech sector, including the communities served by San Clemente, continue to bolster the retail market in this area. Whitestone REIT's CEO, Dave Hamoen, highlighted that the leasing team will capitalize on San Clemente's favorable dynamics and their strong knowledge of the area to deliver significant value to Whitestone shareholders. The center boasts a tenant mix that includes Frisa's, a local Mexican restaurant, Iron Fitness, a state-of-the-art training facility, and Green Lake Energy, an emerging energy technology company. This diverse tenant mix is expected to attract a wide range of customers, enhancing the center's appeal. Christine Mastandrea, Whitestone REIT's president and chief operating officer, added that the center has all the dynamics they look for, including strong surrounding schools, a robust job market, and upwardly mobile families. The potential to actively re-merchandise the center further underscores the value proposition of this acquisition. San Clemente's advantageous location within a 3-mile radius of the Pennybacker Bridge and Redbud Trail, the two main river crossings in the Austin area, defines traffic flow and enhances accessibility. The The center is also poised to benefit from the upcoming Four Seasons development, which will add nearly 200 high-end residences to the area, further increasing foot traffic and demand for retail services. South Florida's retail market is on a remarkable trajectory, showcasing its strength through low single-digit vacancy rates. According to a recent Colliers report, the Tri-County region of Miami-Dade, Broward, and Palm Beach has maintained an overall vacancy rate of 3.5% for 3 consecutive quarters, which is notably below the national average of 4.2%. This consistent performance underlines the robust demand for retail space in the area. Despite this positive trend, the report highlights a growing gap between supply and demand due to limited new construction. With only 9.6 million square feet of vacant retail space available, tenants face constrained options. Colliers emphasizes that new development will be crucial to accommodate future absorption, as the shortage of space is likely to cap leasing activity in 2025 unless development picks up. Retail investors are particularly keen on grocery-anchored shopping centers, with Publix continuing to expand its footprint. In March, Publix acquired a store in Fort Lauderdale for $25 million, and Kite Realty Group purchased a Publix-anchored shopping center in West Palm Beach for $68 million. These acquisitions highlight the strategic focus on securing properties with strong tenant anchors. In Miami-Dade County, the retail space remains tight, with a vacancy rate of 2.9%. This is a slight increase from 2.8% year over year. During the first quarter, 730,000 square feet of new retail space was under construction, slightly down from the previous year's 751,000 square feet. The average asking rent increased by nearly $2.50 to $44.90 per square foot, compared to the previous year's $42.43. Broward County's retail market also experienced a stable vacancy rate at 3.8%. However, the construction of new retail space decreased to 326,000 square feet from the previous year's 515,000 square feet. This led to a modest increase in the average asking rent, which rose to $27.99 from $27.69 per square foot year over year. Palm Beach County saw a slight increase in vacancy rates, rising to 4.1% from 3.6%. Despite this, the average asking rent saw a minimal increase to $29.14 per square foot from $29.04. The county is seeing significant retail leases, such as BJ's Wholesale Club committing to 53,065 square feet at Marketplace at Delray. The strategic acquisitions and leasing activities across these counties emphasize the dynamic nature of South Florida's retail market. With continued interest from major tenants and investors, the region is poised for sustained growth, provided that new construction can keep pace with the burgeoning demand. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.